Hi, my name is Mike Ehrlich, and I'm here at the New Jersey Institute of Technology. Today we're going to talk about the Chinese currency. Now, the first thing about the Chinese currency is people use some different terms for it. Sometimes you hear the term yuan, which is actually the name of the old Chinese currency, and it's also the name of the units of Chinese currency today. The official name for the currency is renminbi, which is complicated for Americans to say, and so we tend to talk about the Chinese, the trading symbol, which is RMB, kind of like USD or US dollars. But all those things are equivalent, and we're going to talk about one or another at different times, but they really all mean exactly the same thing. We're talking about the Chinese currency. Now, the storyline for China in the popular press is focused on the fact that the Chinese have pegged their currency artificially low to the US dollar. And by doing so, they have captured US manufacturing. And so the Chinese now make everything, and of course the Americans now make nothing. And not only that, but the Chinese have collected all of the American wealth, all of these US dollars, and the Americans, in order to buy all those Chinese goods, are borrowing money from the Chinese in order to be able to buy the Chinese goods. And so we're beggaring our future and making them richer. And of course, the Chinese economy has been ascendant. It's been growing very rapidly. It's now the second largest economy in the world after the United States, because they've been growing at, over the last 30 years, at a rate over 10% a year on average, which is a fantastically high growth rate. Now, the concern for the Americans is, what happens if the Chinese stop lending us money? What happens if the Chinese sell their $3 trillion hoard of US dollars? Well, bond markets would go crazy, interest rates would go super high, the US dollar would go down in value, we'd become a poor country, it'd be disaster, disaster, disaster. Frankly, I think that story has been overtold, overplayed, and is unrealistic. The Chinese have said for a long time, the Chinese currency is a matter for the Chinese. It's not a matter for US politicians. US politicians complain about the currency. I mean, they say, look, it's a domestic matter. Stop talking about it. It's not your business. It's our business. And I think, in fact, the Chinese currency is a Chinese story. And in fact, what I'd like to do is start to tell the Chinese story. So what is the Chinese story on the currency? Well, the Chinese story is that 30 years ago, they were a large country in terms of population, but desperately poor. And even if they made something, their own people couldn't afford to buy it. So they relied upon US consumers to basically buy their goods. And so they basically made kind of a deal. Okay, we'll sell the US consumers goods that aren't too expensive, inexpensive t-shirts, inexpensive transistor radios, inexpensive toys. And we're going to sort of team up, the US consumers are going to sort of make a deal with the Chinese government as partners. Right? And so they partnered up and they made this deal. Now that deal is going to sound a little bit familiar for those of you who know history, because in fact that deal sounds a good bit like Japan, the 1950 through 80s, where the Japanese, of course, also started by making inexpensive transistor radios, bicycles, motorcycles, and of course eventually started to make much more high-end goods in terms of fancy electronic goods, as well as Sony, as well as cars and other high-end goods. Well, the Chinese are sort of moving the same way. So over the last 30 years, the Chinese, which relied upon those US consumers, basically were able to grow their economy at a pretty good rate on the backs of the US consumers who were willing to buy those cheap Chinese goods. Not crazy for US consumers to do that, because the answer is the Chinese government artificially was keeping the currency low as a way to build their manufacturing center and build their own wealth. Now, as with Japan in the 50s and all the way through the 80s, the growth in the market came on the back of this low currency. And the Americans have been jawboning that they should raise the value of the currency, but the Chinese said purely domestic matter. Now, the Chinese government needs to have growth. right? The Chinese government, we talk about the U.S. consumers being addicted to cheap Chinese goods. Well, the Chinese government is also trapped and requires growth. Now, why is it the Chinese government requires growth? Well, because in the United States, if we were to have a period of negative growth, we call them a recession, then the people respond to that by saying, hey, we're unhappy with the government, we're unhappy with government policies, and we take the government we have, we replace it. So if it's Republicans, we replace it with Democrats. If it's Democrats, we replace it with Republicans. And we basically change the government in response to the fact that we're unhappy with the growth in the economy, the way the government's been managing the economy. The Chinese government doesn't have any simple mechanism for transformation. If they were to have a period where there was negative growth and people became restive and wanted to change the government, they don't have any smooth way to change the government or make changes in policy. So there's a risk, of course, that the people become restive, and there could actually be a sort of a violent or difficult period for the Chinese government. So they're very addicted to this growth and really require this growth. Now, in order to keep the currency low, right? In order to keep the currency low, the Chinese have actually managed to have to manipulate the currency, which they can do because there's no public trading. So they basically so the central bank really controls the currency. So let's give an example. If we were in Germany and a German manufacturer was making a lot of goods they were selling to the United States, they would receive dollars. Now that German manufacturer, when they receive those dollars, they don't really want dollars. What they really want is euros, because euros is what they pay to their workers as wages, what they pay in rent on their facility, what their utility bill gets paid in, what their taxes get paid in, and it also represents the profit to their owners and management. So when they get those dollars, they sell those dollars and buy euros. Now, if there's a big imbalance where there's a lot more manufacturing more manufacturing in Germany selling to the United States, then in fact, when they sell those dollars and buy euros, they make the euro go up, which makes the goods more expensive in the future, so the trade imbalance levels out. In order for the Chinese government to have maintained a trade imbalance for 30 years and maintain the growth and the cheap goods for U.S. consumers for 30 years and artificially keep their currency low for 30 years, they've had to hold on to all those dollars. And so they've built up quite a stock of dollars. They've actually probably built up reserves which today represent something in the order of $3 trillion. Now those $3 trillion, they don't hold them as dollars, they hold them as short-term U.S. Treasury bonds. But those short-term U.S. Treasury bonds are earning them something in the order of, say, 1% interest per year. Now in China, meanwhile, if the Chinese people, when the Chinese government, the central bank, when they buy those dollars from the Chinese manufacturer, they have to give the Chinese manufacturer RMB, the currency that they're going to use to pay their wages. But in order for the Chinese people to own those RMB, if all the central bank did was to keep putting RMB into the economy, then they're going to create Chinese inflation. And in fact, Chinese inflation is a problem, right? Chinese inflation is already a problem. The Chinese government says it's not that high, but if we were to measure Chinese inflation in a way that's kind of common, say, similar to the way we measure U.S. inflation, we think that rate would be somewhere in the order of about 6%. Now, 6% is not disastrous, but it's awfully high, and they're worried about it rising. Now, in order to reduce Chinese inflation, what the Chinese government has to do, is they have to issue yuan or RMB denominated bonds. But in order to get the Chinese people to buy those bonds, given that inflation is around 6%, they have to issue those bonds at about 6%. Now, the problem, of course, comes in the fact that the currency is pegged to the dollars. Right? The Chinese currency is pegged to the dollar. So that $3 trillion are earning, they have approximately $3 trillion in bonds outstanding. And of course, those bonds are paying out 6%. And if they're pegged, then they're really earning 1% and paying out 6%, which means it's actually negative 5% on somewhere like $3 trillion, which is approximately $150 billion per year. And that money, that $150 billion dollars a year, is a pure subsidy for those U.S. consumers. Now that's great for the U.S. consumers, and of course, I mean, U.S. consumers getting a $150 billion a year subsidy to buy Chinese goods. Why would we not buy Chinese goods? And of course we have. But the problem is that's just not long-run sustainable. Now, the Chinese government continues to build this hoard of dollars. But the good news is, like Japan, the Chinese people have gotten wealthier over the last 30 years. And so they can now consume more of their own goods if we allowed them to be richer. But the way we allow Chinese people to be richer now, because they've got all this saving in RMB, is we allow the currency to go up in value, and then instantaneously, all those Chinese people become a lot richer. If they become a lot richer, then they become consumers of their own goods, and so therefore they're no longer so dependent on these US consumers. They don't really need these US consumer partners anymore. They can shift to Chinese consumers. And so they can shift from US to Chinese consumers. Now, that's something that's already going on. In order to reduce this inflation that China's very concerned about and make their people richer, right, what they're about to do is they're about to change the story. The story that we heard was U.S. consumers being addicted to Chinese goods, U.S. being beholden to the Chinese. I've now told you what the Chinese story is, and the Chinese government is requiring growth and has been sort of addicted to and required U.S. consumption. But they're about to not need U.S. consumption. They're about to reduce these subsidies, and we're about to see the Chinese start to revalue their currency, a thing we haven't seen. But just as the Japanese did in the 60s and 70s and 80s, we're about to see the Chinese revalue their currency. Within the next 6 to 18 months, certainly by the end of 2012, we're going to see significant revaluation of the Chinese currency, which is going to change the terms of trade.